95% of retail traders lose money because they don't understand liquidity and where liquidity is sitting on the chart. The market takes your stop loss and then moves exactly where you predicted. Your stop loss wasn't hit randomly. If you can't spot liquidity areas in the market, have it at the back of your mind that you're the liquidity. If you master how to spot liquidity areas in the chart, you'll start predicting moves before they happen and increase your win rate by 40%. My name is Z, and I've been trading Forex for about 4 years now, and one thing I realized when I started trading is that many trading concepts are explained in a very complicated way, which makes it harder for beginners to truly understand the market. So my goal is to break down complex trading terms and strategies into simple, easy-to-understand explanations, like I wish someone had taught me when I first started trading. So in this video, I'm going to break down liquidity in the simplest way possible by explaining liquidity, liquidity zone, the psychological reasons for liquidity grab, how to identify liquidity zones, and a practical strategy. Without any further ado, let's get to the video. So liquidity is kind of different from liquidity grab, but don't be in a rush. I'm going to explain that real quick. Liquidity is not just a strategy or something that happens in trading. It has a meaning and a psychology behind it. But let me first explain liquidity. Liquidity, in simple terms, is the ability to quickly buy or sell something without affecting its price too much. I'm going to use oranges as an illustration. Let's say you have 3 pieces of oranges and you want to sell them, so you go to the market, and there are people who are actively buying and selling oranges. It's very easy for you to sell your oranges, and you can peacefully trade your oranges without changing the price so much.
Because of the active buying and selling going on, and how easy it is for you to find a buyer who bought your oranges, you can say that the market is liquid, or the market has high liquidity. But on the other hand, if you get to the market and there are very few buyers and sellers, it makes it so hard to sell your oranges that it will leave you with no other choice than to lower the price of your oranges so you can sell and just go home. You see, liquidity is important because it allows buying and selling to run smoothly without causing big price changes. Having explained liquidity with everyday life experience, let's relate it to trading. For example, a highly traded Forex pair like GBP/USD has high liquidity, which means it can be bought or sold easily without making the price jump too much. But a less commonly traded pair like Euro to Turkish Lira might have low liquidity, which makes it harder to buy or sell without pushing the price up or down significantly. So again, liquidity is important because it allows traders to enter and exit positions smoothly without causing big price swings. Now that you've understood what liquidity is, let's talk about liquidity grab or liquidity hunt, whichever one you deem fit. If you could remember, we previously said that liquidity is different from liquidity grab. A liquidity grab is a situation where the market moves to target and take out positions of traders who have placed their stop loss around that level. Another example, let's say price has been bouncing at a particular level. I believe you have heard this phrase that is common among traders. If price touches a particular level 3 times, that means the level is strong. Or, the more price touches a level, the stronger it becomes. I'm not saying that's not true. I only brought it up so I can drive home my point. Back to what I was saying. Institutional traders know how we, the broke traders, are, aka retail traders. I mean, that's what the market movers call us. Anyways, the institutional traders know how we trade, where we take our entries from, and where our stop loss is. I know you might be saying to yourself, but how will they know?
It's simple. When a retail trader sees a price bounce off a level, they enter for a buy or a sell. Smart money also sees these levels, and they know that retail traders are going to long or short the market depending on the trend of the market. So they target the level and take out everyone before moving back in the trader's predicted direction. You might say, what significant change can your $500 or $1,000 possibly make in the market? About 1 million traders across the world probably took that same trade, not just you. It's called clutter, and that's exactly what institutional traders need. So what is the psychology behind this move by the institutional traders? In a simple sentence, to get a favorable or cheap price without causing much significant price change in the market. You see, at the end of the day, demand and supply are what move the market. Institutional traders trade with billions of dollars, and they are in it to make profits. The goal of every business owner is to buy cheap and sell high. That is the mindset of the institutional traders. If an institution suddenly buys $1 billion worth of GBP/USD and there are not enough sellers to match that demand right away, the price is going to shoot up to match the demand. And this is not ideal for institutions because they don't want to overpay when entering a position. They want to get a favorable price. Just to clear things up a bit, let's say you're at a car dealer shop and you're trying to buy 100 cars. If the dealer only has 50 cars available and you suddenly buy 20, the price of the cars would likely go up because the dealer has seen you want 100 cars. So to meet that demand, they might raise the price for the remaining cars.
But when you start buying them in small chunks, like 5 cars at a time, the price won't jump up so much, and you'll be able to buy them at a fair price without paying a premium for each car. After triggering the stop losses of millions of retail traders, forcing them to sell their positions, the price collapses, which will now allow the big traders to buy at lower prices. Then, once they load their large orders, the price goes up and they make profits. And some retail traders who took early entries are drinking their tears. Without the retail traders' stop losses that provide liquidity to the market, institutional traders would have a much harder time entering and exiting large positions without moving the market price significantly. Most retail traders have watched tons of liquidity explainer videos, but still constantly fall victim to liquidity grabs. Maybe once in a while is fine, but if you're a liquidity grab customer, what I'm about to say next should explain why you and liquidity have become besties. The number one reason you have become a liquidity grab regular customer is FOMO, which is the fear of missing out. When traders see prices suddenly shoot up or down so fast, their brains enter a panic mood. Price is moving, everyone is buying. The institutional traders know most people react emotionally to speed, and psychologically, speed means importance, and importance means taking immediate action. So sometimes price moves fast on purpose just to make traders jump in and then reverses to trigger stop losses. There are 2 things that make FOMO very powerful. Number 1 is scarcity, to put it simply. This move won't come back. Number 2 is urgency. Seeing these fast candles on the chart puts you in an urgent mood, and once your brain senses urgency, it numbs its ability to calm down and take time to think and calculate.
The only thing your brain can offer you at that point in time is to act now. By the time you feel safe enough to enter, the move has already happened. You buy at the top of excitement. You sell at the bottom of panic. Am I saying you shouldn't participate in the market when you see an opportunity? No, that is not the point I'm trying to make. The truth is, not every price spike or price dump is worth the risk. In my own opinion and personal experience, whenever my brain is in fight or flight mode, 90% of the time, nothing good ever comes out of it. The second psychological reason most traders have become VIP customers to liquidity grab is overconfidence. Once maybe a beginner trader has won 4 trades in a row, you start feeling like Merlin. They think that they have fully understood and figured out the market. Honestly, this is just overconfidence from a 4-winning streak. It doesn't feel dangerous. It feels more like I'm powerful and unstoppable. Because they now feel like Merlin after 4 straight wins, they often increase their lot size, enter more trades, take trades that are invalid, and move stops wider. This happens because psychologically, their recent success makes the brain feel safer than it actually is. Their internal dialogue shifts from, "Is this setup valid?" to, "I know what's going to happen." I don't know if I've mentioned this in the video, but as a trader, you're an observer. Your job is to use all the available resources to analyze the market and wait for a reaction, primarily in your point of interest, and you react to the market based on the reaction you observe from the market. You don't analyze and wait for the price to validate your analysis when you don't have a $10 billion trading account. Anyways, back to the Merlin guy. So overconfident traders start looking only for information that validates and supports your idea.
For instance, they want to buy GBP USD. Instead of asking what and what would invalidate this setup, they start noticing only bullish candles, minor structure breaks, and indicators aligning. They ignore weak momentum, higher time frame resistance, and lack of displacement. They don't analyze anymore. They just justify and wait for the market to validate their setup. The third psychological reason is impatience. Lack of patience is one of the most important psychological weaknesses with trading. Not waiting for confirmation is rarely a strategy issue, but almost always an emotional regulation issue. The brain hates uncertainty. When the price reaches your level, you don't actually know what will happen. That uncertainty gives you discomfort. Your brain doesn't like the "I don't know" sentence. So instead of waiting for proof, you enter early to reduce the uncertainty, even if it might increase your risk. So early entry gives you a temporary sense of control and relief. I know that waiting is hard, it's boring, and it makes you feel powerless. I can relate. Been there, done that. So when you enter the trade, it feels decisive, because doing something feels safer than doing nothing. And shortly after taking the trade, the market wicks through your stop loss.
Lack of patience makes traders enter at a predictable level with a predictable stop loss, and institutional traders know you're predictable. This behavior creates the liquidity that the market naturally moves toward. The institutional traders might have billions of trading capital and, of course, have more information than retail traders. Some traders will say they're smarter than us. Maybe that's true or not, but what I'll always add is that the market makers are organizations that feed on the predictability of retail traders. Anyways, let's continue. Sometimes early entries work, but it's dangerous because your brain records it. You see, you didn't need confirmation after all. Now your impatience gets rewarded, so next time you enter even earlier. And eventually, liquidity grab punishes the habit, but by then, the pattern is formed. Okay, let's talk about how we can spot liquidity zones. But before then, liquidity zones are price areas where a large number of buy and sell orders are concentrated. In simple terms, they are zones where many traders are waiting to enter or exit the market. Liquidity zone examples are equal highs and equal lows liquidity, support and resistance liquidity, range market liquidity, trendline liquidity, psychological price levels liquidity. For you to fully grasp and understand, I'll explain them one after the other. Equal highs and equal lows are price levels where the market has reacted multiple times at nearly the same point. In an uptrend, price comes down, hits a level, pulls back. Then it comes back down and hits the same low again. This creates an equal low that looks like a double bottom. What many traders do is that they buy at this level and then put their stop loss just below the lows. So below those equal lows, there are lots of stop losses. That cluster or pool of stop loss is a liquidity zone or area. The same thing applies to a downtrend. Price pulls up and forms a high, then later returns to that same level and creates an equal high that looks like a double top. Most traders will see this and sell at that level, then put their stop loss just above the high. So above those equal highs, there are lots of pending stop losses. Again, that is the liquidity zone. Next is support and resistance liquidity. Support is a price level where the market repeatedly stops falling and it bounces up from there, while resistance is a price level where the market repeatedly stops buying and drops from there. What retail traders see is, okay, I'll buy at support and sell at resistance, but smart money sees a liquidity zone. Because retail traders believe that when a market bounces off a level multiple times, it makes it strong, so they buy at support and place stop loss below the support. So below the support is a pool of liquidity that institutional traders will tap into. On the flip side, when traders sell at resistance, they place their stop loss above the resistance. These clusters of stop losses create a liquidity pool above the level.
Institutional traders push the price slightly below support to trigger all stop losses of buyers, collect liquidity, and reverse upward. On the side of resistance, institutional traders push the price slightly above resistance, then trigger the stop loss of sellers, collect liquidity, and then reverse downward. Please note that support and resistance are price levels where the market reacts. They can exist in trending markets or ranging markets. Which takes us to our next liquidity zone example, which is the range of market liquidity. A ranging market is when price moves sideways that it creates kind of a box where price keeps bouncing between the resistance and support without making new higher highs or lower lows. While the market is in a range of support and resistance, it accumulates liquidity. It's more like a balance between buyers and sellers. You already know what comes after this. Traders buy from a support and sell at resistance, and vice versa. When institutional traders step into the market, they sweep one side of the range by creating a fake-out, collect the liquidity it needs, and then move strongly in the opposite direction. The next liquidity grab example is the trendline liquidity. Trendline liquidity refers to the cluster of stop losses that builds up around a clearly visible trend. Many traders draw their trend line the same way, using the 2 to 3 bounce general rule of thumb and dynamic support or resistance. So when price approaches a well-respected trend line, traders buy at the support of the trend line and place their stop loss below the support, and sell at the resistance of the trend line, placing their stop loss above the resistance. So large institutional traders manipulate this market by breaking the trend line and triggering stop losses of retail traders. Then the price reverses strongly. Another liquidity zone example is a psychological level. Psychological price levels, also called round numbers, are whole numbers like 20, 50, 100, 200, and 500. Prices that end in zeros and fives naturally attract traders. These levels are important because traders target round numbers. This causes many buy, sell, and stop loss orders to cluster around the same price zones, creating areas of interest in the market. Price pushes slightly above or below the round number. Stops get triggered. Institutions enter in the opposite direction. Price reverses sharply. For example, retail traders sell at 1.2000 and place a stop loss at 1.2010. Then the price sharply spikes to 1.2015 and then starts selling strongly. The spike was to collect buy liquidity from retail trader stop losses.
Trading with liquidity in mind can change how you read the market. Instead of reacting to patterns, you start to anticipate where stop losses are accumulated and how price may move to collect that liquidity before reversing. Here is a step-by-step liquidity trading strategy you can follow to improve your trading. Step 1. Define the market direction using higher timeframes. Ideally, I use the daily for market direction. Step 2. Scale down to the 4-hour time frame to mark potential liquidity zones where stop losses are likely clustered. Step 3. Mark out your main zone, which can be a demand or supply zone, an order block, a fair value gap, or support or resistance. These levels should be below or above your liquidity zone. If you're still watching to this point and you don't understand how to identify quality key levels and you'd love me to make a video about it, please drop the key level in the comment section. Anyways, always wait for a liquidity sweep. Avoid entering prematurely. Price often moves beyond these levels to trigger stops before revealing its true direction. Step 4. After a liquidity sweep, price often returns to a demand or supply zone, order block, imbalance or fair value gap, or support or resistance, which is the main zone we marked out earlier. Step 5. Once the price taps into your zone, scale down to 15 minutes for entry confirmation. While in your entry time frame, wait for the price to change character and align with your higher time frame directional bias. Then simply mark out the demand or supply zone that caused the change of character and wait for the price to tap into the zone, and then you can enter the trade. Sometimes price can tap into the fair value gap or the demand zone. They both work. Pick the one that works best for you by backtesting. Enter only after confirmation. Place the stop loss below the zone and the target at a 1-to-3 risk to reward ratio or at the next level where the price may move next. Your stop loss should never be random. Place it below the demand or supply zone. Okay, that's it for this video. Please backtest and forward test everything you learned from this video. Drop me a like, subscribe to my channel, and I'll catch you on my next.